Hello everyone, welcome to Yara Fin Talks. Today let's discuss about 7 mutual fund types you should know before investing. Let's go one by one. First type is debt or liquid funds. So basically these kind of funds they invest in fixed income securities like T-bills, government bonds, and these are all very safe and secure investments. So risk could be very less, and returns are also minimal returns. Usually, if you take a typical liquid fund on daily basis, it will generate 0.02% return per day. It will give, and on an average, couple of liquid funds are there where they can give return approximately 7% per annum. These are all best suitable for short-term goals and for parking your emergency funds. I just suggested in my previous videos, having an emergency fund consists of minimum 6 months of expenses is mandatory before investing into any kind of financial instruments. So uh, investors can park their money at minimum 6 months of their expenses into liquid fund so that they can get good returns, minimal return, but at least compared to saving account where you can get only 3 to 3.5% per annum. Here in this liquid fund you can expect around 6.5 to 7% per annum. Next, second one is index funds. Index funds are nothing but they invest in market Nifty 50, that is Nifty top 50 companies, and Sensex. Sensex nothing but Sensex top 30 companies. So a cumulative NAV value will be calculated for investment purpose on either Nifty 50 or Sensex 30 companies. This will be changing on daily basis subject to the market volatility, and risk is very less over here since we are going to invest in either in Sensex 30 means the best 30 companies in the market, and in case of Nifty 50 we are investing in best 50 companies in the market. There is one more index fund is also there, Nifty next 50 is also there. That means next to rather than Nifty 50 companies, the next upcoming 50 companies are nothing but Nifty next 50. These are also good companies will be bucketed in. Hence, the risk is very less, and you can expect some average returns while investing in index funds. So these are all good for beginners. That means those who are new to stock market and those who need not worry about for short term lows and ups. You can choose any kind of available Nifty 50 or Sensex or Nifty Next 50 funds offered by mutual fund AMCs for your investments. Next one is large cap funds. These large cap funds basically invest in well established blue chip companies like TCS, Wipro, Infosys, Pharma, other good blue chip companies they invest in. Hence, the risk is very less and you can expect some steady returns. These are all suitable for, I mean, large cap funds are suitable for conservative investors. That means those who don't want to see much volatility in the market, they can consider investing in large cap bonds. Next one, mid cap funds. Mid cap funds invest in medium sized companies. That means medium cap companies having good growth potential. But risk is we have to have a moderate risk is there, and but you can expect higher returns than large caps, even higher returns than index also. Basically, this is suitable for investors who are willing to take calculated risk for very long term, say 5 to 10 years. If they have long term horizon, they can invest in some good mid cap funds. Small cap funds. Small cap funds, they invest in very small size companies, small scale companies, having very good high growth potential, but these are all going to be very high risk, but returns will be good and significant, subject to if you give proper investment horizon, and if you invest in good small cap funds. For example, if you consider SBI small cap fund growth, that is one of the good small cap funds we'll consider. And I will do a detailed video on these respective mutual funds. I mean, this segments of funds, and what are the best choices that we can invest. I will do a detailed video in a later point of days. And these small cap funds are suitable for aggressive investors. Basically, let us say if you have a 15 years or minimum 10 to 12 years horizon, and and you are willing to do monthly SIP, you can consider investing in small cap funds. But for short term, high risk may be there. So uh, if market is facing very downfall, you should able to see very deep cut in the prices, and your portfolio may become a red also. So you have to consider all these points over here. Next one, flexi cap funds. So flexi cap funds are nothing but they invest in a mix of all three categories: small, mid, and large cap companies. And usually fund manager shuffles, they fund manager picks up selective small, mid, and large cap companies for a quarterly or half yearly basis. They frequently shuffle which are all good performing as per fund manager. So usually this may involve some sort of balanced risk. It purely depends on fund manager who is dealing with what kind of stocks he or she is picking up. And returns, you can expect some kind of good returns around 15 to 17% per annum you can expect, provided if you give a proper time horizon. And the suitability, these flexi cap funds are suitable for who wants to have some stable and growth, and who wants to invest in all the three mix of small, mid, and large cap companies. They can invest in this one. So one more beauty of this flexi cap funds are, in a stock market, if you want to buy a company, you can buy any one single company or two company. But here, if you invest in this small or this flexi cap funds, you are investing in all these companies mix of small, mid, and large cap companies, so that you can reap the benefit of the performance which the companies are doing. Next one, sectorial funds. Sectorial funds means specifically mutual fund which invests in specific business platforms, like in pharma, banking, manufacturing, auto, or IT. They invest in those companies. Let us say if you take IT, an IT sectorial fund invest only in IT companies. So you can get the benefit of, rather than investing in each and every IT company, if you invest in IT sectoral funds, you can get the benefit of the performance of how IT companies are doing over here. But again, risk point of view, this is a little high risk, because um, in any kind of situation, one or two sectors, if they are not doing good, your portfolio may be getting impacted and your returns will be also impacted. And also you can expect whenever there are IT companies are performing very well. If you are investing in an IT sectoral fund and the results are very good, whatever is your portfolio consists of the particular stocks, then you can expect some sort of good returns in that particular area. But this is strictly for high risk takers and those who are ready to take risk and who are ready to expect these are all cyclical returns, they can go ahead with sectoral funds. So ideally this is suitable for those who are masters and expert, those who are having expertise in specific industries, who can foresee how this industry is going to perform. Based on that, they can choose some sectoral funds which are available in the market given by the specific fund AMCs. Thank you.